There is a 36% chance the Fed shocks markets today, and euro to US dollar is sitting on a knife edge at 1.1388. If 1.1365 breaks, the next stop is 1.1325, that is a 65 pip drop in minutes. But if wash sounds dovish, this pair could snap back to 1.1415 faster than you can blink. The ADP jobs number drops in hours. The FOMC decision drops right after. 2 events. 1 pair. 1 trade. The Federal Reserve is about to drop a decision that could send the US dollar to a new 1-month high or collapse it back below 101. There is one danger zone and one hidden opportunity right now. I will show you both. EURUSD is trading at 1.1388, locked in a compression tunnel tighter than anything we have seen since late June. The pair hit a monthly low of 1.13532 just hours ago, and now it is coiling like a spring ahead of the most uncertain FOMC meeting in years. Markets are pricing a 36.3% chance of a surprise rate hike, up from just 16% a week ago. That is a massive shift, and it means one thing: whichever way this breaks, the move will be violent. Stay to the end. I am giving you 2 scalp plays and 1 swing trade you can execute today, plus the one headline that flips everything. Here is the session bias: bearish below 1.1410, bullish above 1.1415. The pair is range-bound and compressing, but the path of least resistance favors the downside going into the Fed decision. Write this number down. If we break 1.1365 today, the entire structure resets. That is the invalidation level that flips the bias from neutral to strongly bearish. Below 1.1365, we are targeting 1.1325, then 1.1280. The herd is positioned long. Retail traders have been buying this dip all week, expecting a dovish Fed hold. That is exactly why I am watching the short side. When everyone is leaning the same way, the liquidity grab is usually in the opposite direction. The stock clusters are building above 1.1410 and below 1.1360, and that is where the real money gets made. Just this morning, Reuters reported that the dollar hit a 1-month high as traders weighed that lingering 36% chance of a Fed hike. The market is divided, the Fed is divided, and that is the perfect recipe for a volatility explosion. Let us read the chart from the weekly down to the 60-minute. On the weekly time frame, the trend is sell. Euro to US dollar has been making lower highs and lower lows since breaking below the critical 1.1500 support level. The monthly trend confirms this. Sell. The daily trend is strong sell. We are trading well below the 50, 100, and 200-day moving averages, which sit at 1.1474, 1.1544, and 1.1548 respectively. That is a bearish stack that does not lie. On the daily chart, the pair is trapped within a downward parallel channel, with the latest triple simple moving average at 1.1510 acting as a ceiling. The RSI sits at 42.5, not yet oversold, which means there is room for more downside. The MACD is negative at minus 0.003, with the signal line below 0 and pointing firmly downwards. That is bearish momentum, plain and simple. Now drop to the 4-hour chart. This is where it gets interesting. The market has formed a consolidation range around the 1.1389 level, currently extending between 1.1336 and 1.1413. This range is nearing completion. A direct downside breakout would open the way for a move to 1.1313. The MACD on the 4-hour supports this scenario. Signal line below 0, pointing downwards. The ADX is at 23.8, which is neutral, telling us that we are in a consolidation phase waiting for a catalyst. The 1-hour chart shows a different picture: strong buy. Price has completed an upward move to the 1.1414 level and is now consolidating below it. The 5-period moving average at 1.1386 is acting as dynamic support, but the 20-period at 1.1416 is overhead resistance. The stochastic is at 25.2, pointing down towards 20, indicating increasing short-term downside pressure. Here is what most traders miss: the divergence. Price is making higher lows on the 1 hour, but the MACD histogram is making lower highs. That is a bearish divergence hiding inside the consolidation. The Williams %R at -73 shows we are approaching oversold territory, but that does not mean a bounce is coming, it means the selling pressure is real. The CCI at -112.67 is deeply negative, confirming strong bearish momentum. The ATR at 0.0051 tells us we can expect about 50 pips of movement today, but that number will explode when the Fed decision hits. Cross-asset linkage matters here. The DXY holds at 101.55, maintaining a healthy uptrend above the 50-day. EMA at 101.12. US Treasury yields have retreated only modestly compared with moves in other markets, which has helped keep the dollar well supported. As long as the dollar index stays above 101.06, the bulls remain in control. The fundamental story is all about policy divergence. The ECB recently paused its tightening campaign, leaving its deposit rate at 2.25% due to sluggish Eurozone GDP expansion. The Fed, meanwhile, remains hawkish with rates at 3.50% to 3.75%, a massive 150 basis point advantage for the dollar. The December 2026 interest rate policy spread has flattened to -1.62%, compared with -0.96% 3 months ago. That is a structural yield advantage that keeps the dollar bid. The inflation differential tells the same story. US headline CPI continues to outpace Eurozone price growth, anchoring expectations that US borrowing costs will stay elevated. Fed Chair Kevin Warsh has declared zero tolerance for persistently elevated inflation and has criticized the Fed for letting inflation run above its 2% target for 5 years. The wildcard is oil. The pause in US attacks on Iran has pushed oil prices lower and somewhat eased inflation worries. But the US-Iran ceasefire breakdown is fresh, and energy supply disruptions in the Persian Gulf and Red Sea have pushed oil and fuel prices higher. If oil spikes again, the Fed's hand could be forced. The 1 to 2 week directional lean is bearish for euro to US dollar. The dollar is supported by strong US economic data. S&P PMIs showed the fastest pace of private business activity growth this year, and initial jobless claims fell at the fastest pace in nearly 6 decades. The US economy added just 57,000 jobs in June, but the labor market remains resilient. Do you think the dollar breaks 105 this week? Comment yes or no. I am tracking consensus. The event that invalidates the bearish view is a dovish shift from Warsh at the press conference. If he signals that the Fed is done hiking, euro to US dollar could rally hard toward 1.1470. But the base case is a hawkish hold, and that keeps the dollar bid. Most people skip this section. That is exactly where the money is made. Keep watching. The ADP non-farm employment change at 12:15 Greenwich Mean Time and the FOMC decision at 6 p.m. Greenwich Mean Time are the two catalysts that will determine which setup triggers. A stronger-than-expected employment reading would reinforce hawkish Fed expectations and likely drive euro to US dollar through its 1.1365 support. A significant miss could trigger an oversold mean reversion rally back toward 1.15. Strategy 1. The opening scalp. High probability scalp. This is the fast snipe, designed for the first burst of momentum after the ADP number drops. The trigger is a breakdown and 5-minute candle close below the major support shelf of 1.1365. I want to see price tap 1.1365 and print a bearish engulfing or a strong bearish close on the 5-minute chart. That is my confirmation that the selling pressure is real. The stop loss goes at 1.1385, just above the local intraday pivot highs. That gives us 20 pips of risk. Take profit 1 is at 1.1325, the major structural daily demand block. That gives us a 1 to 2 risk-reward ratio that if momentum extends, take profit 2 is at 1.1280, targeting a structural multi-month breakout extension. What instantly voids this scalp? If the 5-minute candle closes back above 1.1370, that signals a fake breakdown and we are out. The opening SCALP entry, 1.1365 breakdown, 5M bearish close below support, stop loss, 1.1385 take profit 1, 1.1325 take profit 2, 1.1280 risk, reward, 1 minute and 2 seconds, to TP1, invalidation. Void if 5M candle closes above 1.1370. Strategy 2, the liquidity grab. Counternoise scalp. This one is for the trap, the fake move that suckers in the breakout traders before the real direction emerges. Using the 15-minute chart, I am watching for a sharp move below 1.1360 that wicks down and immediately reverses. This is the stop hunt zone, the cluster of retail stops sitting just below the monthly low. The entry trigger is a 15-minute candle close back above 1.1365 after a wick below 1.1355. That is the snapback confirmation that the downside was a fakeout. Stop loss goes at 1.1345, just beyond the wick, giving us 20 pips of risk. Take profit is fast and singular. 1.1390, the near-term resistance line. That is a 25 pip target with a 1.25 risk-reward ratio warning. This requires fast execution. The fake out and snapback can happen in minutes. If you hesitate, you miss it. The liquidity grab entry. 1.1365, 15M close above support after wick below 1.1355, stop loss. 1.1345 take profit 1. 1.1390 risk, reward. 1:1.25 invalidation. Void if 15M candle closes below 1.1345. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. Strategy 3, the session swing. Trendline swing. This is the bigger picture trade, the one that captures the multi-session move. The bearish trend continuation scenario is my base case. I want to see an hourly candle close below 1.1360. Confirming that sellers have broken the consolidation range. Alternatively, I will sell the rallies on a clean rejection at the 1.1402 resistance wall, the level where sellers have defended the triangle resistance repeatedly. Stop loss goes at 1.1435, safely above the pre-ECB breakdown point. That gives us about 75 pips of risk. Take profit 1 is at 1.1280. Targeting a structural multi-month breakout extension. Take profit 2 is at 1.1250, the full extension of the bearish move. If the hourly candle closes above 1.1410 before we enter, the swing is voided. That would signal a corrective rally is underway. The bullish corrective scenario is the alternative. If wash sounds dovish and the daily close is above 1.1402, that confirms sellers have exhausted momentum. The target would be 1.1470 to 1.1510, targeting the primary moving average gap fills. Trailing stop rule. Once price reaches halfway to TP1, move the stop to break even. Let the winners run. The session SWNG entry. 1.1360, 1H close below support. OR 1.1402 rejection. Stop loss. 1.1435 take profit 1. 1.1280 take profit 2. 1.1250 risk, air reward. 1 minute and 2.3 seconds, to TP1, invalidation. Void if 1H candle closes above 1.1410. Never risk more than 1 to 2% per trade. Scalps demand even tighter risk. These are fast moves with wide spreads, especially around the Fed decision. No positions through high-impact news unless you are already in the trade with a tight stop. Stops are non-negotiable. This is how you survive to trade the next big move. Let us summarize the single most critical level for the next session, 1.1365. That is the line in the sand. Above it, the pair consolidates and potentially rallies toward 1.1415. Below it, the floodgates open to 1.1325 and then 1.1280. Tomorrow's focus is the aftermath of the FOMC decision and Warsh's press conference. His forward guidance, or lack of it, will set the tone for the entire month of August. If this level breaks, the whole monthly trend flips. I will have the updated blueprint 24 hours from now. If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis and then loop back to today's Nasdaq gamma flip later. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter.